$5,000. I just want you to picture that for a second. That number, 5,000 US dollars for one single ounce of gold.
And right there with it, you've got silver. It's just knocking on the door of $100 an ounce.
It really feels like we've woken up in a completely different financial world, doesn't it? I mean, welcome to the deep dive. It's January 20th, 2026. And if you've so much as glanced at a news ticker lately, you know the precious metals market isn't just hot.
No, it's bizarre. Uncharted territory is the phrase I keep hearing, and it really fits.
And the simple take, the one you see all over, social media is just commodities are up, buy shiny things. But today, we want to complicate that story. We're digging into a strategy report and a really fascinating interview with David Wilson. He's the head of commodity strategy at BNP Paribas.
And Wilson is a voice you really have to listen to right now. Just a few months ago, late 2025, he made these calls that, frankly, a lot of people in the industry just laughed at.
I remember that. They called them aggressive, radical.
Exactly. People thought he was just being a doomsayer. And yet, here we are. And not only was he right, he was actually too conservative. The market moved even faster than he predicted.
And this is why we're doing this today. I have to be the skeptic here for a minute. When I see an analyst get a huge call right, I always wonder, did they really know something or did they just get lucky? Because what Wilson is saying now is that gold and silver, they're skyrocketing for completely opposite reasons.
And that is the absolute key to this entire report. It looks like one big tidal wave, but it's really two completely different currents. One metal's rising on this fundamental shift in global risk.
Okay.
The other is rising because of what is essentially a shipping problem.
A shipping problem. You're telling me a $100 asset class is being driven by a logistics mix-up.
A logistical squeeze that inflated into a bubble that Wilson is now calling the death point.
Death point. Okay, just a casual term to throw around on a Tuesday morning.
It sounds dramatic, I know, but the math is there to back it up.
So we have one metal climbing a mountain of solid rock, and the other one's on a ladder made of, toothpicks. We're going to unpack that death point, why silver might be about to crash, and we're also going to look at why $5,000 for gold might actually be the new floor, not the ceiling.
Which is a, frankly, terrifying thought if you're holding cash.
So let's start with the big one, gold. We're sitting at 4,700 and climbing as we're talking. Wilson says hitting 5,000 is no longer a question of if, but when.
And the when is getting closer every day. Mm-hmm. The momentum is just, it's incredible.
But hold on, whenever I see an asset go vertical like this, I don't care if it's a crypto coin or a tech stock. My first thought is always, this is hype, this is FOMO. Is this just people panic buying?
That's a healthy reaction.
Yeah.
Usually you'd be right. But Wilson argues this is different. This isn't a mania driven by greed.
Right.
It's a rally driven by fear, structural fear. He points to two big engines firing up at the exact same time. And they're not just, bad vibes. They're very specific geopolitical events.
Okay, lay them on me. What's pushing us to 5,000?
The first one is something that really caught a lot of people by surprise. The Greenland tariffs.
Right, I saw the headlines on this, the Trump administration's new policy. Mm-hmm. But I have to be honest with you. It's Greenland. The population is, 60,000 people. It's mostly ice. How can a trade spat over, a giant frozen island move a multi-trillion-dollar global asset like gold?
It's a fair question. And on the surface, yeah, it seems totally disproportionate. But it's not about the number of people there. It's about the signal it sends. It's about what is under that ice. It's packed with rare earths, critical minerals, and its strategic position in the Arctic is huge.
So it's about strategic real estate, not population.
Precisely. By putting tariffs there, the U.S. basically just opened up a new front in the global trade war. Wilson's point is that when you introduce that kind of conflict in a totally new region, a place like the Arctic, you're telling global investors that the old rules don't apply anymore.
It sets a new precedent. It says that nowhere is safe.
Exactly. And when you don't know who's going to tax who next, where does big money go? It doesn't stay in currencies that depend on those shaky trade deals.
It goes into the bunker. It goes to gold.
Right. Gold thrives on trade wars because it doesn't care about treaties. But the second factor that Wilson brings up is it's arguably much, much bigger. It's about trust in the Federal Reserve.
The Fed. It always comes back to the Fed, doesn't it?
It's the center of the financial solar system. And the anxiety right now in 2026 is very specific. It's about its independence.
Political independence.
Yes. There's a growing fear in the market, and Wilson really hammers this point home, that the Fed is losing its autonomy. that interest rate decisions aren't being driven by inflation data or employment numbers anymore.
So just break that down for someone who doesn't live and breathe this stuff. Why does that matter so much? I mean, we vote for politicians. Shouldn't they have a say?
Well, the best analogy is to think of the Fed as the referee in a big game. The ref's job is to enforce the rules and keep the game stable, even if they have to make calls that the crowd and the team owners absolutely hate.
Okay, like raising interest rates to fight inflation, it hurts in the short term.
Exactly. It hurts, but it keeps the currency sound over the long run. Now, if the market starts to believe that the referee is taking secret orders from the team owner, the politicians, then the game feels rigged. Politicians, they want short-term wins. They want cheap money and a booming stock market right before an election.
So they might pressure the Fed to keep printing money, even if it's a terrible idea long term.
That's the fear. And if you, as an investor, believe the central bank is being forced to monetize debt, what happens to your faith in the U.S. dollar?
It shatters. The adult in the room is gone.
That's it. If the Fed isn't the independent guardian of the currency, then the dollar itself has risk. It's subject to political whims. Gold, on the other hand. Gold has no counterparty risk. It doesn't answer to a chairman or a committee.
It just sits there.
It just is. So you combine this new trade war in the Arctic with a massive crisis of confidence in the world's central bank, and suddenly $5,000 doesn't look like a bubble.
It looks like a repricing of risk.
That's the term Wilson uses. The world just got more dangerous, so the price of insurance just went up.
Wow. And that's why BNP Paribas is thinking about raising their forecasts even higher. Because once we get over 5,000, that's just the new normal.
That's the theory.
Okay, so that's gold. Going up for structural reasons that aren't going away anytime soon. Now we have to talk about its chaotic little brother, silver.
The parabolic move.
I was looking at the chart in Wilson's report. It looks like a rocket taking off. Since mid-December, so we're talking about a month, maybe 5 weeks, it just went vertical. It's gunning for $100.
It is.
Now, the simple logic is always gold goes up, silver follows. The poor man's gold argument. Is that what we're seeing here? Is silver just drafting behind gold?
Wilson is extremely clear on this point. No, this is not a sympathy rally. This is a supply squeeze. And a really, really weird one.
Weird how?
Well, think of it like a perfect storm, where three completely separate bad things happen at the exact same time. That's what hit the silver market in late 2025.
Okay, walk me through the storm.
So first you had India. Around October, November last year, news started to leak about a new government policy in India related to silver mortgages.
And we should remind people, India is a massive, massive buyer of physical metal. When they sneeze, the market catches a cold.
A huge buyer. So that started stoking demand. The market was already tight. Then, almost at the same time, you get news out of China. Rumors started flying that Beijing was about to implement a new licensing system that would restrict silver exports.
So demand is spiking in India, and at the same time, a major source of supply from China might get choked off.
It's a classic squeeze. But then came the knockout punch in December. From the U.S.
What did we do now?
There were very concrete plans, apparently very far along, for the U.S. to impose tariffs on a list of critical minerals. And silver was right near the top of that list.
Ah, okay, I think I see where this is going. If you're a big industrial user, you make solar panels, electronics, whatever, and you hear a huge tax is about to hit your main raw material.
You panic. You panic buy, and you panic ship. Wilson describes this absolute frenzy of physical silver being drained from vaults in Europe, loaded onto ships, onto planes, just to get it into U.S. warehouses before the tariffs hit.
It's like a bank run, but for silver bars.
It was a logistical nightmare, and the result was this temporary, totally artificial vacuum in the physical market. If you were in New York in December and you needed physical silver, you couldn't get it. It was either being hoarded or it was literally on a boat in the middle of the Atlantic.
So the price just exploded.
It went vertical.
Yeah.
But, and this is the billion-dollar difference, it didn't go up because of some deep philosophical fear about the Fed. It went up because of a shipping bottleneck.
So gold is rising because of philosophy, and silver is rising because of logistics.
That's a perfect way to put it. And that leads us directly to the death point.
I've been waiting for this. It sounds like the title of a terrible action movie. What does Wilson actually mean by that?
He means that $100 an ounce is the danger zone. It's the cliff's edge.
And this all ties into that news from last week, doesn't it?
Yes, the big U-turn. The White House came out and announced they are pausing the tariffs on critical minerals.
So the threat, the entire reason for the panic shipping, just vanished.
Poof, Gone. For now, anyway.
Mm-hmm.
And look what happened the second that news broke. Silver dropped 7% instantly.
And I checked this morning, it bounced right back. It's still climbing. Doesn't that prove the market is strong? That people really think silver is worth $100?
Wilson calls that a dead cat bounce. He says it's only recovering because gold is acting like this huge gravitational force, and it's pulling silver up with it psychologically. People see gold screaming higher, and they think, well, silver must be safe too. But the actual fundamentals for silver, that physical shortage, they've completely collapsed.
How do we know for sure they've collapsed? Is there actual data on that, or is he just guessing based on the tariff announcement?
No, there's hard data. He points specifically to the lease rates.
Okay, lease rates. We need to unpack this because this is where a lot of people's eyes glaze over, but it sounds important. Explain it to me like I'm trying to rent a car.
That's actually a perfect analogy. So if you show up at the airport and there are 500 rental cars sitting on the lot, what's the price like?
It's cheap, supply's high.
Right. But what if there's only one car left and 10 people are trying to get it?
The price goes through the roof. Bidding war.
Exactly. You can lease or borrow silver in the same way. Back in December, when the vaults were empty, the lease rates for silver were sky high. It cost a fortune to borrow the metal because there was none to be found.
Okay, so what are those lease rates doing right now?
They're crashing, dropping like a stone.
Which means the rental car lot is full again.
Exactly. The metal is available, the shortage is over, the panic shipping stopped, the warehouses are full.
So let me get this straight. The rental price says the shortage is over, but the purchase price is still acting like the shortage is critical.
And that massive disconnect,
Yeah.
that is the textbook definition of a bubble. The price is still high, but the support beams holding it up have been completely kicked out from underneath.
So why $100? Why is that the specific death point? Why not 95 or 105?
He thinks it's a huge psychological number for the speculators.
Yeah.
You have to remember, the silver market is tiny. It's a puddle compared to the ocean that is the gold market.
It's not very liquid.
Very low liquidity. And right now, that little puddle is packed with speculators. People holding paper contracts, just betting on the price because the chart looks like a straight lineup. Wilson's prediction is that the second silver touches 100, all those people are going to say, okay, triple digits, I'm out. Take profits.
And when everyone tries to take profits at the same time.
In a thin market, you get a stampede for the exit.
A crash.
A major U-turn. He thinks the price could free fall almost immediately after touching that number because there are no real buyers left to support it. The industrial users, they aren't buying at $100. They know the tariff is off. They know the lease rates are low. They'll just wait.
So the only people left buying at these levels are the people who haven't read this report, the ones buying the hype.
Exactly. They're buying the chart, not the underlying reality.
It's just such a stark contrast. You have gold, where the buyers are basically saying, I don't trust the system, I need an insurance policy, and they're holding on. And then you have silver, where the buyers are just saying, I want to make a quick buck on momentum.
It really is a tale of two different motives. Gold is the border. Silver is the casino.
And Wilson is telling everyone the casino is about to close for the night.
He's saying cash your chips in before they turn the lights out. Because when that selling starts, there's just no floor underneath it.
You know, this whole thing really highlights how we tend to lump precious metals together. We say, oh, I invest in metals. But this deep dive really suggests that's a dangerous oversimplification right now.
It really is. It forces you to ask why something is moving. Is the driver sustainable? Gold's driver is global instability, questions about the Fed, trade wars. I mean, unfortunately, that seems pretty sustainable. It's not going away next week.
But silver's driver was a government policy announcement that got canceled.
Temporary versus structural. That's the whole lesson here.
So if we zoom out, what does this tale of two metals tell us about the bigger picture? I mean, are we just in trouble?
I think it tells us that risk is being permanently repriced. That $5,000 number for gold, the fact that the market is beginning to accept that as normal tells you that the collective faith in the old system is just, it's gone.
We're not going back to the days of 2% inflation and quiet, predictable geopolitics.
No, that era is over. When you buy gold at $5,000, you're not buying a pretty rock. You're buying an insurance policy against the system you no longer fully trust. The fact that the price of that insurance is now considered normal is the real story here.
It's a sobering thought. And the silver story is a reminder that even when the world feels chaotic, basic market mechanics, supply, demand, liquidity, they still matter.
They absolutely still matter. And a crowded trade in a small market is and always will be a recipe for a disaster. If you're holding silver right now because you think it's gold's little brother, you might want to double-check that family tree.
So if I'm listening to this, looking at my phone, and I see all those flashing green numbers next to both metals.
Just remember, not all that glitters is driven by the same engine.
I see what you did there. But it's true. One is shaping up to be a floor, the other a ceiling.
5,000 is the foundation. 100 is the trapdoor.
I want to leave our listeners with one last thought that really struck me from Wilson's interview. We always call gold a safe haven. But if the safe haven now costs $5,000 an ounce, does that mean that safety itself is becoming a luxury good?
That is a profound question. If you have to already be wealthy to afford the thing that protects your wealth from systemic risk, what does everyone else do? What about the person with $500 in savings?
It points to a world where the wealthy can just opt out of the volatility and the rest of us are forced to ride it out.
And maybe that's the real uncertainty we should all be focused on.
Indeed. So as you watch the markets this week, ask yourself, are you buying the bunker or are you playing in the casino? Knowing the difference could make all the difference.
Couldn't have said it better myself.
Thanks for diving deep with us.
My pleasure.
Stay curious, and we'll catch you on the next deep dive.